The Tax Cuts and Jobs Act of 2017 brought with it some exciting changes, like the expansion of bonus depreciation to additional assets and allowing 100% bonus depreciation. But it's important to remember that the eligibility for bonus depreciation starts to decrease by 20% per year, starting with this year in 2023. With this in mind, you might be wondering how cost segregation will fare if bonus depreciation phases out. Is it going to be worth it? Before diving into the impact on cost segregation, let's get a better grasp of bonus depreciation. It's a provision under Section 168K of the tax code that lets businesses immediately deduct a percentage of an eligible asset when it's put into service. Although bonus depreciation feels like it's been around forever, it was actually introduced in 2002 as part of the Job Creation and Worker Assistance Act, where businesses could deduct up to 30% of eligible assets. Now, let's address the big question. Will the reduction of bonus depreciation affect cost segregation? Well, the answer is both yes and no. While the immediate deduction will decrease, taxpayers will still save significant money with a cost segregation study. Cost segregation studies are typically assessed using three metrics. One is the first-year cash flow savings. Two is the 5-year cash flow savings. And three is the net present value, or NPV, over the life of the asset. The first-year cash flow will be the most affected, since cost segregation studies are designed to move as much possible into shorter bonus-eligible assets. To better understand that, let's consider a scenario where a $200,000 is moved from a 39-year asset to a 5-year asset by doing a cost segregation study. Assuming a 35% tax rate and a 7% discount rate. With 100% bonus depreciation, the taxpayer saves $69,028 in the first year, $61,746 over 5 years, and has an NPV of $42,731. These numbers decrease as bonus percentage drops, but the taxpayer still sees significant savings by completing the cost segregation study. As bonus depreciation gradually decreases, the importance of cost segregation for commercial renovations grows. The Tax Cuts and Jobs Act, as fixed by the CARES Act, made qualified improvement property a bonus-eligible asset. But without bonus, it becomes a 15-year asset depreciated using a straight-line methodology. The difference between 5-year depreciation and 15-year depreciation becomes more significant if bonus phases out completely. So what does it all mean? While there are multiple bills in front of Congress that could extend bonus depreciation, it's uncertain what the federal government's going to eventually decide. Even if bonus depreciation does phase out entirely, cost segregation will continue to be a valuable tax planning tool for both businesses and residential real estate investors.